And on the way up, you've got a Pesalo Digital, 5% up on that, and GMDC, BHEL, Zomato.
Yeah, no, absolutely. Look at Policy Bazaar. There's PB Fintech. News came yesterday towards closing the last hour, and we put that out, by the way. So ICICI Lombard, the largest general insurer, which was not available on the PB Fintech platform, is now part of the PB Fintech platform. It'll be available on the PB Fintech. You can buy all those policies on the platform. So PB Fintech is seeing a large 5% move. It's the largest volume. It is one of the largest, not the largest, but one of the largest volume-led gainers this morning coming through. Look at Indigo, right? Indigo, of course, is, I think, pretty much at a new high. Fares are going up. There is a player in the market which, of course, has had recent troubles. I'm talking about Vistara. And, of course, Indigo is going there and adding capacity as well. So just a few other names. Shah Metallic, we just had the company with us, 4.5% higher there, 647. That sort of, expansion in on the stainless steel side, entry in the stainless steel flat product side, really. HEG is up about 1.5%. Kolte Patil is up 4% this morning. There is Sona Comstar, which is up about 3% or so. So it's a, pretty vibrant screen. 2:1 in favor of advances to declines is what we have. I think Rima did mention Indus Tower, right? Indus Tower is down 2, and there's a call there as well. IRB, we'll be speaking with the management. IRB is down 4% this morning, and it's got volumes as well. And IIFL, which had rallied about 25% last 3 or 4 days, that's pulling back just a little bit, 2.25% or so. This morning.
So, on Kolte Patil, right, you mentioned Motilal Oswal has actually initiated coverage on that stock. They say that the growth potential is now getting unlocked and they have a target price of 700, which is almost a 35% upside to the current market price.
Yeah.
Now, the big thing that they talk about is not only is the performance picking up quite a bit, because Kolte Patil is increasing their presence now in the Mumbai metropolitan region, the MMR region and the Bengaluru market, which are high growth areas. But there's also a very healthy balance sheet that Kolte Patil is sitting on, and that's the reason for which they are very bullish on the stock. Stock is up almost 3.5% today. But if you look at, the last 7 days, the stock is up almost about 12% odd. So, real estate continues to be the flavor of the moment now.
No, absolutely. And that's absolutely right. Yesterday, of course, Godrej Properties saw a big move. We should actually look at Godrej Properties as well and see what's happening there. So many other names are starting to participate as well. Market, breadth is, of course, positive, but it's too early. It was 2:1, but it's slipping. 1,050 stocks are higher, and you got about 900 stocks which are lower. So, what started as a very strong one-way kind of a move is moderating a little bit at this point in time. Vedanta was at about 355. It's come off to about 351. BHEL is another one into the mix, right? Which is, it's up at about 260, 2% higher. GMDC is another one. Look at GMDC, which is up about 4% or so. Very large volumes. BEML is another one. We had a defense company with us in the morning, Paras Defense, but of course, these are the larger ones. BEML is up about 2% or so as well. So, lots happening. Well, we'll come back to more names in a bit. The Nifty is up about 50 points, so can't complain. Gautam Dugar is with us, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, good morning. Good to have you with us here. Thank you very much for your time. We are, of course, at the cusp of another earnings season. And I was reading the story on, it was a money control story, and that kind of aggregated earnings expectations from, you guys, Motilal, and a bunch of others as well. And what they're pointing out too is that earnings growth expectations for this quarter are perhaps one of the lowest that we've had over the last 1 year or so. We've kind of seen some earnings cuts, etc., going into the earnings season as well. Just wanted you to contextualize that. Are we starting to see a deceleration in earnings growth, or is it something else? Go on, Gautam.
Hi, Prashant. Good morning. So two different points there. First of all, you have to look at the context of what happened in the first 9 months. The first 9 months earnings growth in Nifty was 26%. And we had expected sub 10% kind of a growth in fourth quarter, because we had done the 4-quarter split right at the beginning of April, as we always do last year. So this quarter 6% growth, therefore looks a bit softer. But you have to look at the nuances behind that. Number one, it's being dragged down by commodities, which is metals and oil and gas. So for my coverage, if you remove these two sectors, the growth is about 12%, right? If you look at the similar number for Nifty without commodities, the growth is about 9-10%. So yes, versus the first 9 months, it looks a bit soft. But also remember that for the full year, you are ending at 21% earnings growth, EPS growth for Nifty. Next year, we are expecting about 14-15% kind of an earnings growth number. So there's 980 rupees of EPS that we are building in for FY24, which has been pretty stable, by the way. There's been no cut for the last 7-8 months now. We were around similar 974 number in October 23, and now we are at 980 rupees. So broadly stable for FY24. FY25, we are down from 1130 to somewhere close to 1120. So marginal 1% cut. Now, if you do 14-15% growth even next year, then this will be the first time after a long time that for 5 years in a row, you're talking about a double-digit earnings growth. Because last 4 years, between FY20 to FY24, Nifty earnings have already compounded at 22%, from 3.4 odd lakh crores to somewhere about 7.8 lakh crores. And if you look at a broader market and look at our coverage universe of 270 stocks, we are talking about a compounding of 27% between FY20 to 24, right? From about 4.3 lakh crores to about 11 lakh crores this year. And our expectations for next 2 years for our coverage universe, the broader universe, is about 16% compounding for next 2 years, from 11 lakh crores to somewhere close to 15 lakh crores. So I would say, quarterly fluctuations aside, the earnings momentum for corporate India is very solid. And like we mentioned in our report, it almost feels like a mini Goldilocks because macros are fine, earnings growth is fine. So yes, this quarter is a bit soft because of commodity, but otherwise the trend is quite intact.
Okay. Gautam, hi, good morning and thanks for joining in. I have to ask you your view on what's happening with the rise in gold prices, right? I mean, in so many years of tracking the markets, I've never seen a time where gold is rising like this at a time when equities is also surging. But it also speaks about how the power play is perhaps seeing a tectonic shift away from the west to the east, with China buying so much gold to hedge against the dollar. What does all of this mean for an equity market investor?
So Sonia, it's futile to predict, the commodity prices. This is one thing I've learned in the last 17 years being in markets. Whether it's gold, crude oil, metals, you just cannot predict it. Yes, it is a bit, unprecedented that you are seeing equity markets at a new high. Gold prices are doing well. At the same time, the 10-year yields of US have risen also. And there is a potential discussion on rate cuts timing. So not everything adds up, right? So at some point of time, something has to give away. Now, a job of an investor, especially equity market investor, is to look at investable ideas in investable sectors. You can discuss, where the gold prices are going or where the crude oil prices are going, but the probability of you getting that right is next to zero.
Gautam, my question is more to do with asset allocation, right? A lot of people are having this missed out feeling, left out feeling in this gold rush. So what is your advice to them? Does it make sense to still buy at these levels or just, stick to plain old equities? Because a lot of the buying that you're seeing in gold could also be speculative.
So, Sonia, all I can say is one should have a very diversified asset allocation based on one's risk profile. Unfortunately, my expertise on gold is very limited. Yes, we do like some of the plays on the gold in the listed equity space, which is where we have a very bullish view for last 10-12 years, part of our model portfolio too. But from an individual's asset allocation perspective, obviously he or she should have some gold in their portfolio. But beyond that, it's going to be very difficult for an equity market guy to comment on that.
Gautam, morning. Rima here. This entire recovery or the continuation of strong earnings growth is also predicated that consumption picks up at some point of time, right? Is that a big risk? Because consumption has been lagging, rural has not picked up as of now. When do you expect consumption to pick up? And will that be a big risk to monitor? And also a little more on commodities, because commodity prices have started going up.
So two things, Rima. First of all, next year's growth is not predicated on consumption picking up. If I give you the numbers, next year's 16% growth, roughly 50 to 65% of, or rather 2/3 of the incremental earnings are coming from 3 sectors, which is financials, metals, and metals is obviously rebounding from the low base. So it's a bit of an optical element coming into play. And then you have some recovery built in IT, right? So consumption per se, we are not expecting any big up move, at least in staple companies' earnings. In fact, our own estimate for staple earnings next year is somewhere about 8 to 10% earnings growth, which is way lower than what we are building in for the index. Vendors, consumption revive, there are two aspects to look at it. Consumption is a very broad ocean and there are multiple subsegments. Some of them are doing exceedingly well, things like hotels, things like discretionary names and jewelry and all. They're doing phenomenally well. What is lagging, however, is the low ticket consumption item, right? Which is staples, the home and personal care and things like that. Now, for that to recover, there is a requirement of 2-3 things to happen. Number one, the monsoon needs to be normal, which is a good thing because there's a prediction that this year's monsoon is going to be normal. Point number two, inflation needs to come down, which is also happening, by the way. So inflation prints are coming off. And third, this is a hope that the political spending in the forthcoming elections, which at some point of time with a lag of 6-7 months, will propel consumption at the bottom of the pyramid. So if I remember well, 2019 general elections, the total political spending as per various estimates was about 60,000 crores. It's fair to say that this year should be closer to 1 lakh crore. Now that kind of money trickling down will obviously take some time before it reflects in the numbers of consumption companies, but that's a hope. Because this stocks, this volume growth, top line growth have been lagging not just for last 2-3 years. If you look at the last 10 years data of consumer staple companies also, hardly 1 or 2 consumer staple companies have been able to compound their top lines at 10%. Most others have compounded at 6-7% top line growth. I'm not even talking about earnings. So top line has been very, very lackluster for almost a decade now. So that's a hope. But from our point of view, we are still very, as far as our model portfolio is concerned, we are completely positioned towards discretionary consumption. So out of the 9 stocks that we hold in model portfolio, 8 are discretionary in nature. There's just one consumer staple company.
Got that. Gautam, just to come back to metals, right? Not asking you to predict prices, impossible to do. And of course, the old adage, right? Metals are best bought or sold at extremes. Actually, on the selling side, tough to say when it's at an extreme, but easier on the downside. Now, of course, they're not at the lower end in terms of valuations or anything. But and I know that I think Hindalco is part of your model portfolio, but I wanted your thoughts on Vedanta here. It's actually 2 names, Vedanta and Hindustan Copper, if you have. I'm sure you've looked at the business. Vedanta, of course, is a play on a variety of commodities, but also it's been going through a fair bit of turbulent phase. Hope, of course, always has been that they're able to sort those issues out. So it'll be able to realize its full value. Just your thoughts, Gautam.
So, Prashant, unfortunately, I will be able to comment on individual stocks now as per the revised disclosure norms. Any which ways, Hindustan Copper, we don't have a coverage. But to make a broader point on metal space, just remember, Prashant, that when we are talking about next year's earnings growth of 35%, our numbers for Nifty metal companies, including Coal India, the profit number is somewhere close to 72,000 crores. This year they will do 53,000 crores. But do remember that this 72,000 crores, if it is achieved in FY25, it will still be 30% lower than what the metal profits were in FY22 when they hit 93,000 crores. So there is some element of, as I said, optical illusion built into it. And there is also a fond hope that the global economy will show some recovery, especially China. Because when you talk about metals, obviously the big elephant in the room is always China. So that is our expectation that there will be some recovery in metals profitability, and which is why we've raised allocation on metals in our model portfolio from being underweight for last almost 9 months to now being neutral.
Okay, all right. By the way, I think you have a lemon tree, which is part of your model portfolio as well, right, Gautam? So you may want to hang on and listen to the next conversation which is coming up, which is, of course, the lemon tree conversation. The management, I think, is with us and he's ready so we can go across to him. So they've, of course, crossed the 10,000 room mark. It's also launched the first property in Nepal. To discuss some of this and, of course, their expansion plans beyond India, we have Mr. Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels. Mr. Keswani, good morning. Good to have you with us here. Thanks very much. Things have been going great. So every time we get you on, the first question always is, do things continue to remain as great? Or have you noticed any downshift or even upshift, if it's possible, in that sense? I'm talking about occupancies and average room rates.
Well, the good news is there is no downshift. But, we have now entered H1, which is typically the low season for the hotel industry. And when I can compare it to the previous year, I don't see anything which is less than last year. There is, I think, a slight pickup in demand. But overall, as I think I've said earlier, there is, I think, going to be a structural shift in demand in India for branded hotel rooms. And elements of that, I think we already see playing out. And this will continue for the next 3 to 5 years, in my opinion.
That's interesting. So, Mr. Keswani, hi, good morning. Can you tell us a little more about what this structural shift in demand could be? How is the demand-supply situation right now? Because a lot of segments, say, weddings, for example, right? Prime Minister Modi has indicated that a lot of the weddings now need to happen in India versus happening abroad earlier. So that would, of course, give rise to further demand. So I'm just trying to understand, when you talk about a structural change in demand in the industry, what are you trying to, what are you getting at?
Good morning, Sonia. Well, I think what I'm trying to say is that it has been, typically in our business, we look back and look at the trends and then try and project the future, which is some form of forecasting. So what we are really saying is we know how much supply is coming out in the next, say, 3 to 5 years. We know the trend lines of demand growth based on various parameters, and then we try and project what the likely occupancy and therefore price will be. But when I say structural, what I'm fundamentally saying, and this is not only true for hotels, I think this is true for the overall consumer discretionary story in India. It is that, in the past, about 60% of our personal consumption expenditure was always going towards staples. But when you go forward and, as the economy grows, that percentage will keep reducing because there is, you consume staples and that's that. Beyond that, as your income grows, and there are increasing cohorts of Indian consumers who are now moving into a position where every year with the growth of, say, 6, 7, 8% in the Indian GDP, there will be maybe 8 to 10% of Indians who move into an inflection point where their incomes are such that they spend much more on what earlier was discretionary for them. So they start basically moving from discretionary to non-discretionary. And that is what I talk about. So that is no longer looking back and saying every year this sector, this segment grew at 5% or 10%. This is a hockey stick growth because you have a very large number of Indians who will suddenly start, for example, traveling in SUVs on 4-lane highways within 4 hours of urban centers in India and going on holidays. I mean, this is just an example. So that is basically what I'm trying to say. And that typically happens in a country's economy when the GDP per capita, moves from $2,500 to $3,000 per capita.
Got it. So when you talk about a structural uptrend, you're talking more about consumer preferences also changing, and now India moving from, say, a low income to a middle income economy. So, spending more on discretionary things. Got that. Absolutely. But how are you going to capitalize on all of this? If you can tell us a little more about your expansion plans. What is the hotel opening pipeline for FY25 and over the next, say, couple of years?
So broadly, I reckon that we will open about 2,000 to 2,500 rooms this financial year. And we will add or put in our pipeline another maybe 3,000 rooms. So overall, the inventory will grow 20-25%. And the pipeline will grow by about 3,000 rooms, which is about 30%. So basically, our intention is every year we add more rooms to our pipeline than the number of rooms we open.
Does the political calendar or the IPL boost demand just in the near term?
Yes, in some cities it boosts demand wherever events like this happen. And as far as the elections go, obviously there is more travel, but conversely also less demand in some ways. So I think it balances out.
There will be no perceptible improvement in demand due to elections or IPL in Q1?
No, that's not structural. That is event-based. But
yes, event-based, but just in the near term.
Yeah, So there will be some improvement, but in some cases, because of, all these rallies and so on and so forth, people will also not want to travel to a city. So I think on the balance, it evens out.
Aurika in Mumbai, what's been the occupancy?
Well, that is, I'm in a blackout period, so I don't want to comment on the occupancy. But overall, I can say it is in line with what guidance I have given, that the demand is quite good.
Absolutely. Mr. Keswani, if I can request you to take a question from Gautam Duggar, who's been listening by. He's head of research at Motilal Oswal, tracks the company, and stock is part of the model portfolio. I'm sure you know him well. Gautam, go ahead.
Thanks, Prashant. Just wanted to understand, Mr. Keswani, good morning.
Good morning.
Do you see the cycle extending? I don't want to basically ask about specifics of the company, but hotels as a sector has done exceedingly well post-COVID, right? Whether you or your peers. And we are seeing some of the subsectors in consumption, something like a real estate or other discretionary consumption sectors. The cycle is prolonging this time, and this has not happened in the past. Margins have gone up, occupancies have gone up, and demand is outpacing the supply CAGR. How long do you think this can last? Is it a 2 year, 1 year? Just some perspective on that would be very helpful.
So, good morning, brother. Typically, we do look at the hotel industry, all of us, as a cyclical business. And therefore, we say, how much is demand growth? And, looking back, what was normal demand growth linked to a certain rate of growth of economy? What is the supply growth, which is known because it takes a few years to build a hotel? And then we try and project occupancies. But the broad point I'm trying to make is that if you look 15 years ago, 16 years ago to, say, Indonesia, and a year or two before that to China, and then go back to other countries that were roughly at this point of GDP per capita, as is in India, there is a magic number. The magic number was $7,000 per capita, which means roughly $35,000 per household. At that point, there was a huge change in demand for branded hotel rooms. And if I look at China or Indonesia, say 2006 to 2013, the annual rate of growth of demand for branded hotel rooms was CAGRing at over 22, if I remember right, 22%, as opposed to earlier years when it was less than half of that. Broadly, this is when, and I'm sure you understand this, very well, that there was a very large number of consumers who suddenly started consuming branded hotels. And therefore, the looking back of trend lines and linking it to growth per person and GDP and so on was no longer valid. So it was like a hockey stick for that 5-year period. And then again, it stabilized and started growing at 7, 8, 10% a year. So what I'm trying to say really is that we are on that runway. Now, whether it happens, in 1, 2, or 3 years, I cannot say, but I'm 100% sure it will happen in the next 4 years.
Okay. It's interesting that we're having this discussion because the other thing that is, India is benefiting from, Mr. Keswani, and I'm sure Gautam, you would agree as well, is this huge demographic dividend that we're sitting on, right? I mean, India has about, 600 million people who are in the age group of 18 to 35. And I think one of the youngest population in the world. So, and at a time when now the younger generation prefers to spend on experiences rather than things, Mr. Keswani, do you think that is an added incentive? Is that something that you guys have already priced into your, say, average room rate predictions, for example? I mean, do you think that there could be a disproportionate rise in some of these metrics purely because of the demographic dividend?
So it's a very interesting point you're raising, Sonia. So let me just give you, for the hotel sector or the tourism sector, what I would call 4 high-frequency indicators of demand growth. One is the number of runways in India. So right now we have, I think, roughly 150 airports with a certain number of runways. I believe this 150 is going to go to 250 in the next 4 to 5 years. That is what the government has announced. Number 2 is that the number of seats or airplane seats in India is poised to grow from current to 2.5 to 3 times this in the next 4 years. The number of 4-lane highways in India have grown 3x in the last 4 years and is continuing to grow at that rate. The rate of growth of demand for SUVs today, that's a magic point, by the way, is already 50% of total demand for passenger cars. So when you look at all these, what does it tell you? It tells you that there will be far more growth in travel, both by car and by air. Number two, you link that to the fact that, as you mentioned, demographic dividend, the new younger Indian is far more aspirational, driven by credit. So my guess is that one big sector that will grow enormously in the next 5 years will be the industry that provides credit to young Indians with good credit management, because they spend today and pay later. They are aspirational, they are brand driven, they are experiential. They are typically under 30, 35. We see that in our own hotels. So you just put all these, try and connect all these dots. And the broad point, which I think we have all kind of agreed on, is that there will be no longer 6, 7, 8% growth in demand, but for maybe the next 5 years, starting maybe this year or next year, that demand growth will structurally shift towards, say, 15, 20% a year.
For a couple of years in that too. Mr. Keswani, fantastic conversation, sir. So interesting when you sometimes pull back from the quarter-on-quarter numbers and look at the bigger picture. You get and very good data points on the airports and the capacity which essentially is going to come up over the next couple of years as well. Thank you for joining us and good luck. Hope to speak with you after the fourth quarter numbers. Gautam, if you're there, thank you very much for asking that question and staying on as well. Thanks indeed. We'll take a quick commercial break here. We'll come back and we have the management of IRB Infrastructure. We discuss the news this morning, of course, apart from the business updates as they've come through. Stay with us. We'll also, after that, be joined by Devina Mehra, First Global, and we discuss all things markets, macros. So that's going to be an interesting one as well. Stay with us.
Well, IRB Infrastructure is the next management on the show. The company's toll collections rose 30% to almost 481 crores in March. Also, in the IRBAV tollway versus the NHAI case, the arbitral tribunal has ruled against the company. To discuss more on this, we have Tushar Kavedia, who is the Group CFO of IRB Infrastructure, who joins us now to talk about that. Tushar, thanks a lot for joining us. First, I want to ask you a little bit about the toll collection, right? Can you give us an update on that? Year on year, what is the growth that we're looking at in FY25? What's your prediction? And also, there are some reports on toll stoppages because of some unrest. Have any of your collections been impacted because of this? If yes, what's the update there?
Yeah, sure. Thank you. And good morning to all. So if you see our performance for FY24 on the toll collections, where we have seen a good, robust growth month on month, and the year by ended with almost 24% annual growth from a group perspective, which includes the private InvIT asset as well. And for the month of March, it was almost 30% growth on a YOY basis. Looking to this performance and adding of the new assets which are from the NHI side, that is TOT 12 and 13, which commenced its operations from the April 1. These two assets will start contributing to the toll collections in the next year. And looking to the past performance on the toll collection, we expect a good robust growth for the FY25 as well. And as such, we have seen that the GDP expected for next year is around 7%. So which leads to a traffic growth for us, and corresponding there will be a tariff hike with link to inflation, which we expect around 4 to 4.5%. So considering both the parameters, the growth is expected around 10 to 11% of the for the next year, FY25. Now coming to the obstacles, we have not seen any obstacles in our collections. The collections are going fine across all projects. There is no hindrance on the toll collections, and they are operating very smoothly. One thing I want to update on our performance for the last year, that this whole year FY24 was remarkable for us, considering be it toll collections, be it acquisition of new assets. We were able to acquire a couple of TOT assets, which bring us to the largest TOT share in the country with 37%. We have
Tushar, we'll get to individually each of these in just a bit from now. Good morning, Prashant here. A great performance, really. Could you, but if I can sort of ask you to comment on this, the long pending case in terms of the traffic diversion at AV Tollway. Is that a bit of a setback? Can you sort of contextualize that for us?
Yeah, sure. So if you see, we have got the arbitral award yesterday only, and we were also being saddened with the award. So looking to the award, if you see, our claim was with respect to the competing facility to the particular stretch, and which was the claim was filed for from the year 2015-16, when we have seen this competing facility has come up parallel to our stretch. Now, if you see the arbitral award, the award has already has considered this competing facility. But the year which they have considered is 2019 instead of 2015. So looking to our claim, which was relating to 2015-16, the timelines is something which is now the basis of contention in the court of law, where the claim is already being
Tushar, what was the size of the what was the amount under dispute?
So amount of dispute, when we say that amount of dispute was due to the competing facility, say around from 2015-16, it was close to 1,000 crores, but it is a continuous claim which will exist for every year, because this facility is already treated as a competing facility even by the arbitral tribunal. Now, this is, you said 1,000 crores or 2,000 crores? I missed that number. No, 1,032 crores, which was since 2015-16, which was filed in as a claim in our in the arbitration claim itself, and which was for a particular period. Now, this is a continuous claim which will be for a year-on-year basis, and looking to the order as such, the arbitral tribunal has already agreed that there is a competing facility, but due to technical difficulties, since the compensation compensation documents were not available, the computation document were not available, the award was without considering
denied.
that aspect, and denied. And this leads us to a strong case, a prima facie strong case to challenge in the High Court, where we will put forward our case basis our computations for the claim, considering this as a competing facility.
So you will be filing a counter claim in the higher courts, and you're hopeful that you will be granted that compensation of 1,032 crore. What's the timeline for that?
So again, we have the legal remedy available with all the advice of our legal counsel. We will take this forward. And we will, in due course, we will be taking this in the courts as well.
What is your current order book? We have the update as of December 31st. Moving on to business now, 36,200 approximately. What does the number stand at? And what is now the executable order book over the next 2 years?
So if you see our order book with addition of this new TOT stands at 36,000 crores, and the executable order books for next 1.5 to 2 years is around 10,000 crores, which includes an EPC order book of 7,000 crores and balance towards the O&M order book of the projects under the operations.
And your L1 orders, what does that stand at?
We are just waiting. There is a good pipeline from NHA available on the BOT space, where we have a lot of expertise, and we are the largest in that particular space. There is an ample opportunity coming from NHA side, and 2 trillion of assets worth of assets is expected to come for bidding in next 1.5-2 years, and we are quite confident to get couple of them with the added advantage of having partners like GIC and Centra, and also the healthy balance sheet what we have today after deleveraging ourselves. So that leads us a more competitive edge compared to others, and we will be more benefited with this strong balance sheet going forward for new biddings as well.
But Tushar, the awarding by the NHAI has been a bit muted, right? In FY24 at least. How much has it been so far? And what is the BOT projects that will be coming up for bidding?
So as of now, if you see, due to the code of conduct, the bidding was slightly slowed down. But if you see, they have already shortly listed the assets which are going to come for bidding. We expect in few months these assets will come up for bidding. Out of this 2 trillion, we have seen 30,000 worth of assets are already had come for bidding, and the balance will come in a phased manner, which we believe should be there in 1.5-2 years of time.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Yeah, go ahead.
Yeah. With respect to the claim, the arbitration claim, I just want to point out one more thing, that the project is doing good and it has shown almost 12% kind of revenue growth in last 2 to 3 years. And considering that aspect, going forward, we should be comfortably meeting our debt obligation. In fact, the premium obligation in the balance concession period, which is expected around 20 years from now. And if at all, if you see the valuation of this particular asset in our whole valuation of IRB, is quite minuscule and non-significant, because what we have seen, the analysts are just giving a weightage of around -1 to ₹3 for this particular asset, and without factoring any arbitration award in this case. So as such, we don't see any impact of this order as such on our valuation.
Just one quick question. Can you take us through the entire process of the secondary stake sale that happened in the private InvIT? How were the valuations arrived at? And what does the entry of Ferrovial mean for InvIT prospects? Does funding become easier? And will you look to aggressively target more?
Yeah, so if you see the confidence of our investors, which include the strategic investor like Centra, that continued, and we have seen this deal happening at the private InvIT level, where they are acquiring the stake from GIC of 24%. And with the valuation, what they are paying, there's a price is 67 billion for the acquisition of 24%. What we have seen, the valuation, just doing the maths, it's like for the 10 assets which were part of, which were operational, it was almost 2.5 times to the book. And with that kind of valuation or the fair deal, we see that the total valuation considering all assets would be somewhere around 400 to 480 billion. And looking to that size of valuation, where IRB owns 51%, it gives a fair value for the IRB stake as well. So this platform itself has been valued by the strategic investor, and they want to participate in the growth platform where the value was created since the time it has been created last 3-4 years back.
All right, we leave it at that. Thanks a lot for joining in and all the best. That's IRB Infra. By the way, the market is picking up pace, not so much the headline index, but I think there's a lot of action in the mid-cap end of trade. The mid-cap index is now up almost 300 points, and it just goes to show that this is such a momentum-driven market. There's so much money that has been flowing in from the domestic fraternity. Now, FIs have started to participate as well, and the going is only getting better. In fact, Devina Mehra is joining in. She's the founder, chairperson, and MD at First Global, and she's joining in to discuss her view on the market. Devina, always great speaking to you, and you know, good to know that you are in Mumbai. You're in Mumbai right now, right?
Yeah, I'm in India.
Okay, you're in India. So good to see that, and hope you have a good stay here. But, you know, it's been a great run for this market. Not just Indian markets, global markets are doing well. Commodities like gold are doing well. How are you feeling about, you know, the global market situation right now? And what's the best way to approach it for the rest of the calendar year?
So I am quite positive on the global market, especially the equity side. So that remains, that has been my stance for a while. And Besides, everybody only looks at US, so that obviously looks fine. And but the good thing has been that unlike 2023, where for the first 10 months, there was only one thing which moved, which was the 7 mega tech stocks. And that was actually a worrisome time because the S&P move, let alone the NASDAQ, 90% of it was just 7 stocks. But from November onwards, that has broadened quite a lot, and which is a good thing. And some of those magnificent 7, as they are called, have fallen behind. Tesla, I was reading just a couple of days back that it was the worst performing. It has been the worst performing stock so far in the S&P this year. Of course, it rallied a bit since then, but. So as I always say, the themes change, the leadership changes, but there are always opportunities. And one market which we have been overweight on from, I think, about a year ago has been Japan. India also, in our global funds, we are somewhat overweight. China, we've been waiting for a bottoming out, but that bottoming out hasn't happened yet. So yeah, there are a lot of things where you can... there are a lot of opportunities, and equity markets in general look fine from a medium-term perspective.
So Devina, China has not bottomed out. What will be the markers to assess when China bottoms out, and what is your own view on that market? When will it bottom out?
That is difficult. I mean, as I said, we've been watching actually the last 6 months, that it's just as we were watching Japan beginning of last year for a signal, and that signal came around April and we went overweight. But China has been among the major markets the most beaten down one, and people try to kind of correlate things with the economy and say that what happens in China and therefore what will happen in terms of economic terms, and therefore what would happen in the market. But it's not so simple. The very fact that the Chinese market made a high in 2007, and since then the Chinese economy is up 7 times and the market has not taken out its high, it shows you how far the disconnect can go. So you have to watch the market indicators rather than what is happening in the economy.
Devina, hi, morning. Prashant here. Now, where does one get to make money? I know that in the near term, your view is a bit cautious, next 1 to 3 months, right? So one got to protect downsides as well. But what about commodities? Suddenly there's a fair bit of excitement. You know, that old thesis of a big super cycle and metals like copper is making a comeback. It's a thesis, but we'll see where it goes. Oil prices, 90-ish, sort of hovering there, and other commodities have also been doing well. Is that the space where you think one can sort of make incremental money from here? Just talk to us about that, Devina.
Yeah, so in our rebalance, which we carried out just now in the last few days, because we rebalance every quarter, we've added a couple of metal names since you spoke of commodities. But I mean, I am not into these grand narratives of super cycles and so on, because the narratives always follow what is happening in the market. And commodities upticks often don't last very, very long, because that is not beneficial for the majority of the world. But I mean, as of now, as I said, the metals looked good. We've added a couple. As far as the market is concerned, yes, I mean, while I'm cautious about the next 1 to 3 months, that doesn't mean that you should be out of the market, because I always say that there's a risk of being invested in the market, which is a risk of a downside, but there is also a risk of not being invested and missing out of on an up move. And up moves often happen when you least expect them to. So unless there is a possibility, very clear possibility of a big crash, which I don't see, it is better if at all you want to do anything, you can hedge a bit. We were hedged up until now. Those hedges expired. We are just reevaluating how many hedges, how much to hedge now. But we definitely are not making a big cash call, and we plan to be mostly invested. In terms of sectors, I've often spoken about capital goods, industrial metals. So we've been trimming every quarter, but we still remain overweight. Last calendar, from beginning of 2023, we went overweight autos and pharma. We've added in both these spaces in this rebalance also. We'll be a little overweight construction. So broadly, that's what we have done. IT is one space I'm watching for bottoming out this year, but again, still waiting for the signals for that to happen.
Any early signals? No, not yet.
Yeah, I mean, I expect sometime this year that would happen, but right now we are not overweight.
Chemicals, and that's another global sector, especially agri-chemicals?
I mean, right now our systems have not signaled any big names there. We'll keep a watch. Again, it's a volatile area, and also see chemicals, while we talk of it as a chemical overall segment, often what happens is that something which is good news for one segment of the market is bad news for another segment which uses that product as an input. So chemicals, you have to go into details about every company's product list and what's happening in each of those things. So it's not a sector where I think broad calls work.
Devina, just coming back to the larger theme, right? There is so much talk about de-dollarization right now in the global markets, especially with what's happening with gold. But this is a narrative that has been going on for a while. How are you looking at all of this, and how do you think markets like India could either benefit or fit into the scheme of things if de-dollarization plays out?
I don't think it's going to happen in any meaningful sense. And as you said, these are narratives, which means they are stories. And stories always follow what's happening in the market. And I'll take you back to 2003 to 2007 when emerging markets did so well. Emerging market index went up 3.5, 4 times. India went up 6, 7 times. And at that time also you had heard that US is over and this is now going to be the century of India and China. That's when BRICS was coined. But as soon as the outperformance of emerging markets went away, all that story was forgotten. So de-dollarization is not going to happen in a hurry. It has, even over decades, very little of that has happened, either in terms of how much of the trade is built in dollars or in terms of how much of the central bank reserves are held in dollars. And really, if you look at it, what are the alternatives? Euro to an extent is there, which anyway is used, or a little bit of Swiss franc. But still, dollar remains the major currency. And if you're talking about the Indian rupee, for instance, becoming an international currency, I mean, think about it, who would want to hold Indian currency beyond the point that you are importing from India, which is what happened with Russia rupee trade, that beyond a point Russia said, what are we going to do with the rupees? China has a better case simply because they export so much. So, therefore, their currency is acceptable in more places because the countries can use it to import something from China. But on a larger scale, I don't see that happening in a hurry. So this is all story.
Okay, and why are you not in the camp of a commodity super cycle, Devina?
Again, see, this is super cycles are all stories. If you go back and look at the same people who are talking about super cycles, when had they said it last and what happened? So normally that doesn't, commodities, as I said, hurt a lot more people than they benefit. So commodity bull markets are typically something people don't like, unlike most other bull markets, and therefore difficult to sustain. And so, I mean, stories can be formed anytime, but I don't see that like it happens for a period of time. I'm not saying it will, the commodity prices may not go up for a period of time. I told you we've added metals, but I don't believe in these like 10-year cycles of commodities.
Devina, by that same token, would you agree that this entire narrative, and I would call it a story as well, that China is going to disappear as a viable market for investment managers, and ex-China funds, etc., will be the new thing? You think that's also a passing fad?
Sorry, I missed the first part. What would disappear?
We're talking about stories, right? We're talking about stories and how they rarely play out. Sometimes they do, but for short periods, as you said. This narrative, right? China +1, and then take China out of the equation, and the ex-China funds. Do you think that is also kind of a passing fad, a story which China perhaps is just too big to ignore in that sense? Briefly, Devina.
Yes, of course, China is a very large market, even on an overall sense, not just in of course, it's the largest in the EM. Because it has not been doing well, that is when people say that, just take it out. And that often is closer to the bottom of that market rather than the top. So as with all themes, any kind of thematic funds or schemes come near the peak of the cycle, or in this case, because you're taking out China, you can say it's probably a signal that China is closer to the bottom.
Absolutely, and I think that's an important framework to remember. Thank you very much, Devina. Great to have you with us here. Great chat as always. Appreciate your time here on CNBC TV18. Thanks indeed. Well, that's Devina Mehra with thoughts on markets, global markets, commodities, the market here, sectors she likes and everything. We'll take a break here. Mitesh will be with us with some technical trading ideas on the other side. So we'll talk about here and now. Nifty's up 40 points. Stay with us.
Welcome back. All eyes are going to be on Zomato, whether it crosses that 200 rupee mark. It's gotten precariously close to that, 198. The high today was 199.6. That's the intraday high on Zomato, 199.6. So will it touch the 200 rupee mark? It's had a fantastic run. Zomato is up 60% in this year itself. Mitesh is now back with us to walk us through the day so far and the way ahead. Mitesh, your 10 a.m. calls.
Yeah. See, I think the day has been quite positive, and the good thing is that the Bank Nifty is trading positive. I think, I expect the strength might remain. And in that sense, yesterday's low for the Bank Nifty becomes our trading stop loss. Having said that, Castrol is something which has been enjoying a good momentum, and today is seeing continuation. So buy here. Keep a stop at 218.5. Look for targets of 240 in the short term. And other one is the Midcap stock. The breadth is also showing good momentum. So NLC India is on my radar. The breakout happens at 239.5, 239 levels. So I think buy above that with a stop at 230 and look for a target of 265.
All right. Thanks a lot for that. Well, let's shift our focus to the commodity markets, where all the action is really for the last many days and weeks. So Manisha has her hands full. Manisha, what's the one commodity you're tracking today?
Well, it's difficult to do that really, Sonia. So while gold and silver are trading at an all-time highs in the Indian markets and the international markets as well. But I do want to talk about industrial metals right now, because the strong manufacturing activity that we are looking at globally seems to be supporting this. So when you look at the manufacturing numbers from US, China, Germany, all of that has improved quite strongly, and that in turn has been supportive. I want to start talking about zinc first, because the latest outperformance has come in from this one. It's trading at a one-year highs right now, and we are trading above $2,700 a ton onto this one. The reason that zinc prices are in support, because there are reports of various mine closures in Australia and Ireland as well. In any case, the zinc demand seems to be improving, especially in Europe and China as well. The other metal on your screen clearly should be copper, because this is where it all started. LME copper is trading at a 14-month highs. There is a very strong fund buying that we've seen. If you look at the Chinese copper prices, they are trading at an all-time highs. When you look at the US copper prices, well, they are trading at a 16-month highs. So when you look at the global markets across time zones, copper seems to be doing well in each one of them. We also are looking at stronger strength going forward. Also, when you look at LME and Shanghai right now, the gap is the widest since 2013, and there's a lot of arbitrage opportunities and trades that we are seeing happening between both of these exchanges. And this is what the brokerages are now saying. Citi for one sees copper at 9,700 in 3 months and at $10,000 a ton by fourth quarter. Citi also has a report suggesting that $12,000 of an all-time high copper is what you could be looking at in the next year as well. So this is not a short-term rally by any chance or standards that you're seeing in copper. Goldman Sachs also is talking about $10,000 a ton of copper, and they expect that price in this year itself. So very strong going when it comes to copper prices there. Platinum is another one, and the prices are trading at a 4-month highs onto this one. In the last 3 trading sessions, we've seen platinum prices gain up by 12%. So $1,000 an ounce is back in case of platinum. Tin is trading at a 15-month highs. Indonesia has restarted mining, but there are concerns about regulatory approvals going forward, and that is keeping these prices in favor as well. So as I said, everything from copper, zinc, tin, lead, nickel, aluminum is trading in the positive and at multi-month highs. I also want to take you through on what we've done in the previous 1 week when it comes to many of these metals. So copper is gained up by 3.5%, but copper has been gaining for last 5 weeks now. Aluminum, similar story, 1.5% up in this week as well. Tin has surged up recently, so 7% of gains onto this one in a matter of a week. And when you look at the other metals, zinc is up 7.5%, lead 7%, nickel 7.5%, and all of this movement in these prices has happened over the last 6 or 7 trading sessions itself.
All right, Manisha, thanks very much for that. So commodities really, seeing a lot of move across the board. We'll take a quick commercial break here. We've got another very interesting chat coming up, right? Water, that's the next big problem over the next many decades, and how to solve for that. So we have Rajiv Mittal, Managing Director and CEO at VA Vibhag, joining us, and we also have one of the foremost infrastructure analysts, Vinayak Chatterjee, founder and managing trustee of the InfraVision Foundation. We talk about what can be done, what is being done, and of course what are the opportunities as companies figure out ways to solve this problem. Stay with us. Welcome back. We're talking about perhaps what's going to be talked about quite a bit more over the coming years, which is the water crisis, right? Now, companies, of course, lots of companies are dedicating themselves to solve for the problem through various ways. The government of India, of course, has been sort of involved quite heavily now over the last couple of years as compared to any time in the past. So let's actually dive into this topic in some detail. We have Rajiv Mittal, Managing Director, CEO at VA Vibhag. We also have Vinayak Chatterjee, Founder and Managing Trustee, the InfraVision Foundation. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mittal, let me start by sort of taking the first question to you. At VA Tech, from what I understand, you are betting big on you're betting big on taking desalination, right? That's essentially the big bet that you're making at this point in time.
That's right.
How is this different as compared to what you did 10 years back? Because I remember back in 2013, 2014, there was a lot of excitement around your company, around what the potential is, because the problem was well understood even back then. And then, of course, things kind of did not go as planned. Investors especially are making a big bet on you and the theme once again. So what has changed in the intervening 10-year period, Mr. Mittal, if we can start by asking you that?
Prashant, good morning, and good morning to your viewers. Vinayak, also good morning to you. Nice to see you here. See, I think the question is relevant today, and it was relevant 10 years back, and I'm sure it will be relevant 10 years from now. The things what has changed is in last 10 years, there's more awareness on this topic. Even if you see our first desal plant in Chennai for municipal corporation was way back in 2010, which we completed and commissioned in 2013. So this is not new. And Chennai gives us the opportunity. Even recently, Chennai has placed Asia's largest order, which was JICA funded, 400 MLD, 4 times bigger than what they had built about 13 years back. So I think we have to realize that water, fresh water, is a limited resource. And where do you get it? You are so much dependent on weather, and with all the climate change happening, the rainwater is becoming highly unpredictable. And we can't develop our economies, we cannot develop infrastructure, communities need water. And with our standard of living going up, our consumption of water patterns have gone up. The only reliable source we have to look at, which are the perennial source. 97% of the water on earth is in seawater. And it will be, I think, sad if we don't tap that seawater, which is a perennial source, reliable source, drought-proof source. And today, it's also affordable.
So, Mr. Mittal, that's what my point is. Is it affordable now? Is it vastly more affordable, these plants, as compared to what they were 10 years back?
See, if you talk about affordability, 10 years back also it was affordable. The prices have come down with the technology is moving up. The power consumption has come down. The power cost has come down. The quality of products have improved.
The cost of running these plants has come off quite a bit. Got that. Mr. Mittal, I'll just come to you. Let me get Vinayak into the conversation as well. Mr. Chatterjee, talk to us about, is desal, as Rajiv put it, Mr. Mittal put it, the accepted solution now as far as this solving for this problem is concerned? Water?
Well, it is one of the solutions. So, but to answer your question, I will need to step back a little and talk about 4 buckets of solutions. The 4 buckets, one is geographical interventions. Second is policy interventions. Third is micro-level interventions. And the 4th is technical and technology-related interventions. So if you just give me a few minutes, I will just bullet point some of the key issues in each of these buckets. Let's take bucket 1, which is the geographic solution. And I'm looking at India, the country and the economy as a whole. Remember, we have had developments like the Rajasthan Canal, which has seen the greening of the desert from North India, Northwest India, right up to Gujarat. We have seen the commencement of river linking projects very recently with the Ken-Betwa river linking. These are major interventions to take water into arid areas and impact livelihoods. Second, in the past, India has been a leader in multi-purpose hydro and dam projects. Think of the Damodar Valley project, which conserved water by controlling floods. You actually harvested and stored water, which otherwise would have led to the flooding, useless flooding of a large portions of Bihar and Northwest West Bengal. So these are examples of geographic interventions on water conservation, water management at a country level. Then very recently, 3 months ago, very interestingly, since India's independence, the first ever census of water bodies was published. That has turned the spotlight on how we, first of all, do we know how many water bodies there are in rural and urban India, and what do we do about them? Because as you know, water bodies are a very severely neglected source of water supply to communities. And finally, in many rural areas, there is the whole movement of check dams. Now, all of these relate to geographic interventions to address the water shortage issue. Come to policy. Policy, the biggest dampener on policy on water sector is the free power given to agriculture, because farmers use it randomly, wantonly, and it is documented that it has led to the reduction of water tables across large portions, certainly of Punjab and northern India. Then there is the issue of urban planning. How seriously do our town planners pass plans for townships, industrial complexes that choke water bodies as well as channels? And the floods in Madras are a testimony to lack of discipline and oversight by urban town planners and town managers. These are policy level interventions. Come to micro.
Mr. Chatterjee, let me just get Mr. Mittal into this conversation as well, right? About all the policy interventions that are happening at the moment. Mr. Mittal, you know, by 2030, the water demand in India is projected to be twice as much as the supply. And that's quite concerning. Do you think enough processes are put in place, both on the private and the public sector end, to set up these comprehensive water, wastewater treatment facilities? And what more do you think needs to be done?
I think, Sonia, it's very clear. We as water managers, that is our job, to get these challenges. What you mentioned, the demand is far exceeds what supply is. And that's where we come in. We come in, what we call it, into a manufactured water. We just don't depend on the natural water which we get as a God's gift by rains or from glaciers. This is hardly any water. If what you just now said was on desalination, that is one solution, at least for all the coastal cities. India is a vast coastline, about 7,500 kilometers. Why can't we set desalination plants when Chennai has demonstrated this viability, economic it is, and it's affordable and it's reliable because it's drought proof. The second one which I would like to emphasize, which is even more affordable, is recycle of water. We have to realize water is a limited resource. We just cannot abuse water. We have to conserve water. Why we are not recycling water when globally this is well accepted? And at least you start for the industries and agriculture, which consumes almost 98-99% of our water. You talk about supply, and just hardly 2-3% goes to a domestic consumer. For domestic consumer, we can use desalination water. For all other, we can use recycle. And that is also infinite resource. It's a drought-proof resource. It's also reliable, affordable. So my short answer, Sonia, to you, yes, we have solutions and we can build a water secure, not only India, but the whole world. We can build a water secure in terms of water availability.
Mr. Mittal, you know, if I can sort of ask you to distill from the macros to the micros with regards to your company, because I mean, a lot of the audiences will also be investors in your company. Could you tell us what is the order book at Viatec Vabag right now? What do you expect it to? Yeah, sorry, go on.
See, it's more than 12,000 crores.
Okay.
And a substantial part, what we are discussing today, is desal and water reuse.
Got it. What's the visibility in terms of order pipeline from here?
I think we are very bullish about water. You know, we are a pure play water company. Other than water, we don't do anything. If you even see globally, water is a big topic and India is second to none. There's a huge opportunity. So we will not be short of opportunities in terms of water.
What percentage of your order book comes from municipalities, local organizations? Because, I mean, you know, that was where back, I mean, I think 8-10 years ago, receivables, etc., had become a bit of a problem. Could you tell us if that is kind of a shift moved away in quite a significant way now, Mr. Mittal?
Yes, it has. I think, Prashant, you have seen yourself that if you see last 3-4 years, we have been always cash positive. So those days are gone. There was a shift of strategy. Our selection of projects was all about the payment security. If you see, 98% of our order book is today based on multilaterally funded projects. central government funded where we have a sovereign guarantee, and for international projects we have a letter of credit. So those days are gone. I think if you see in the last 4 years, I think we are back on cash positive. We generate free cash, and this is the way we want to grow in future also.
Mr. Mittal, you had put out a number. Actually, the reported number is about revenues are about 3,000 crores last year. That is FY23. We'll get the numbers for this year shortly. Once again, going back 10 years, you had put out a revenue target back then of €1 billion, right? Is that still kind of the aspirational number? I mean, and is the road looking a little more firm now? I mean,
yeah, it is. See, it is always firm. When you drive on the road, you don't know. Sometimes the speed breakers may come or potholes may come. This was like COVID potholes coming, which has taken the whole thing 3 years back. But our targets are firm, and we don't have a year when we want to achieve it. So we want to do it earlier than later, but we also have to be aware of all the geopolitical challenges which are there in the thing. We want to reach our target in a healthy way rather than reach a target and then we say, why did we reach? So we are aware of our target and we are moving towards it, and the opportunities are immense.
All the best for that. But Mr. Mittal, one final question. In terms of FY25, FY26, what kind of average revenue growth are you looking at, and will it be disproportionately higher to what you've seen in the recent past, purely because how demand-supply dynamics are playing out?
See, Sonia, we have always looked at 15-20% CAGR growth, but you should also be aware, because of strategy, some of our stagnant European subsidiaries we have divested. So those revenues which were there a year back, you will not see it now. But because of a huge order backlog, we will continue to grow in that range of 15-20% CAGR, and we are very confident. We have moved also away from the construction. We are going to more focus on technologically challenging jobs and doing more engineering and procurement of key components, which is where we bring a differentiation in the market.
Okay, all right. Well, gentlemen, thank you so much for joining us. We've run out of time, not out of questions, but thank you for putting some light on this extremely serious and important topic about water shortage, not just in India, but globally, and how some of these players are big beneficiaries of that, especially in the water desalinization space. That's a wrap on Bazaar. Chartbusters coming up next. Do stay tuned in.
Vedanta gains on a bullish call coming in from brokerage firm CLSA, which has upgraded the stock to buy from underperform. Also raises target price to 390 rupees a piece from 260 rupees earlier. The stock up 7%.
Kolte Patil jumps over 8% now after Motilal Oswal initiates coverage on the stock with a buy recommendation, citing the company's growing presence in the Mumbai metropolitan region and Bengaluru markets.
IRB Infra slumps in trade after the arbitration tribunal rules against the company in their case against NHAI. The management tells CNBC-TV18 there is a strong case for them to file a case with the higher courts.
Shyam Metallic shares also climb up to 1.5% after the company announces its plans to foray into the stainless steels business. The management says that they will invest 650 to 750 crore rupees for the expansion, and they expect incremental revenue of around 5,000 to 6,000 crores from the stainless steel expansion.
Protean e-government surges nearly 5% off the highs. Nearly 21.5 lakh shares worth about 241 crore rupees change hands. Sources tell CNBC-TV18 that 361 funds is the likely seller.
Hello and welcome to Chartbusters on CNBC-TV18. I am Hormus Fatakia. With me is Mangalam Malu, and as always, the Nifty over the last 3 sessions, that has been the case, is finding some bit of resistance around 22,700, but it's a positive tick nonetheless. The banking stocks are doing well. Again, 48,900 is where the Nifty Bank is at, and overall it seems to be a pretty good day as we head into the holiday season.
It's an incredible day. You know, one would look at the indices at the top of our heads and say, oh, the Nifty is up just 60 points and the Nifty Bank just 144 points. The point is that it's holding up. It's not giving up any of those gains. A little bit of resistance is par for course. The good part is that the broader markets are feeling a lot better today, with the Midcap index up around 0.8%. Saw a bit of profit taking and now has moved forward once ahead at the high point of trade, a fresh record high for that index, and a lot of stocks doing extremely well as well. If there was one music that the market is playing today, it would be heavy metal, and that's what's plaguing, you know, everyone's ears over since the start of this week. A lot of stocks doing extremely well out there. The metals index up about 1.5%. So let's take it straight then to Sony Patnaik, who's joining in for a quick check on the market and trading strategies as well. Sony, good morning. Metal stocks doing extremely well. The Nifty facing a bit of resistance. Do you think it should be used to buy into, and what would your top stock picks be?
Hey, good morning, Mangalam, Hormas. Thank you so much for having me on the show. I think you rightly pointed out that Nifty is facing some sort of a resistance around 22,750, 22,800. But definitely, you know, if we look into this dip, it should be bought into 22,600, 22,500. That range has got multiple support and very strong support, in fact, to speak of it. So, you know, any move above 22,750, 22,800 today, you can see a sharp short covering, which can lead today's expiry above 22,900, 950 plus levels also can be tested. So I think it can be a positive expiry. And if you look at the most important parameter, yesterday's FI's positioning in long short ratio, it has increased dramatically from 43% longs to 51% longs in a single day. So definitely both the indices have quite a positive outlook. Even talking about Bank Nifty can surprise any move above 49,000. You can see straight heading towards 49,500, 50,000 levels as well. So I think both the indices quite strong, and you know, as long as the support is intact, you definitely must buy into.
Right, and as Mangalam was highlighting, right, there's some bit of resistance is par for the course, because one must also not forget that from the March 20 lows that we made, which was 21,710, the Nifty is up almost 1,000 points from those levels. So some bit of resistance there, but still the market's holding up. But in light of that, Sony, what are your top stock recommendations for the day?
So the first pick would be from the chemical and fertilizer space. We're seeing quite good, strong momentum today, and the pick is Chambal Fertilizer. Strong long built positions getting added today. Can buy at current levels with stop loss of 375 and a target of 400, 410 can be seen in the coming short-term trading perspective. And the second pick is Container Corporation. Concor, again, quite strong, good intraday breakout on charts, long built positions. Can buy at current levels with stop loss of 920 and target of 1,020, 1,040.
All right, Sony, thanks a lot for joining in. I would have wondered if you had some metal pick as well, but for now, PSUs are the way to go forward to. Just keep an eye out on Reliance Infra. Reliance Infra, the stock is down around 4.5%. That's on the back of the news that Ashmit, our colleague, is sending from the courts, that there has been a big setback for Reliance Infra and a relief coming in for the Delhi Metro Rail Corporation. And it was the Supreme Court which has set aside 8,000 crores as the arbitral award, has upheld the DMRC's curative petition. And as a setback has come in, as Ashmit has been pointing out, the stock is down almost 6%. A vertical decline is what we're seeing on that counter. That's about individual stock news. We'll try and get Ashmit in to give us some more details of the proceedings at the Supreme Court right now, because the stock continues to fall now, down almost 7%. But in that, while we do that, let's also get you some ideas for profit coming in from our colleagues at Money Control Pro. And today we have Anant Chaudhary, who's joining in with a stock that he's been tracking.
So today's stock idea is Prince Pipes Limited, a leading manufacturer of polymer pipes and fittings in India. The company produces a range of pipes including UPVC, CPVC, PPR and HDP. It has used in various applications in plumbing, irrigation and sewage disposals. We find Prince Pipes promising for several reasons. First, it is among the largest beneficiary of the ongoing upswing in the real estate sector. Government initiatives like Housing for All and Jal Jeevan Mission are also driving growth for the company. Polymer pipes are also gaining traction over metal pipes due to their lower cost, longer lifespan, and easier installation. Second, PVC prices have now stabilized at around 80-85 rupees per kg, down from 180 rupees. General inventory has now normalized, and demand prospects look very promising. Prince is focusing on expanding its market share by optimizing its pricing strategy through the implementation of ERP system. Lastly, Prince has historically performed well in the North and West region. However, the future growth is expected to come from the ongoing brownfield expansion in Bihar, where the company is planning to do a capex of 200 crore to add 50,000 tons of capacity, which will be operational by Q4 FY25. The expansion also includes fittings, which has higher margins. Stock looks reasonably valued at 19 times on FY26 earnings, following a period of price consolidation over the last 3 years. Key risks for Prince Pipes could be slowdown in the real estate activities and any sharp fluctuation in the PVC prices.
Right, with that, we'll take a short break. Come back on the other side. We'll have Dheeraj Singh, the CEO of SIS, to discuss the company's business outlook and a small acquisition that they've made about 4% in an elder care facility. The broader markets continue to do well. A couple of stocks which have moved higher. We have Godavari Power and Ispat, again a metal ancillary, doing extremely well. Apart from that, we have Bombay Stock Exchange, BSE Limited, which has recovered about 6% from the lows, opened in the red and now has moved to the high point of trade. So many volumes, trading volumes, so many large trades, etc., helping the cause of the exchanges. This is the only listed play, and as a result of which we are seeing an up move out there as well. But talk about another stock, SIS, that's on our radar. The company has announced an investment of up to 10 crore rupees in Agarsha Senior Care, an integrated elder care platform. We have Dheeraj Singh, who's the CEO of the company, joining in to discuss this and a lot more about business as well. Thanks a lot, Dheeraj, for joining in. You bought about 4% stake for 10 crores, valuing the company at 250 crores. Just wanted to understand your rationale for this and why start with such a small amount. What's the upside here? What's the kind of scalability that you're looking at?
So Imoha is India's largest elderly care services company. So it's clearly is the market leader. And it currently has 66,000 active elders out of whom 45,000 are paying elders. And this is growing at a compounded rate of almost 75-100% year on year. For us as SIS, we see this as a proxy play on the healthcare segment. We believe we will ride similar proxy plays on residential infrastructure as India's overall growth happens over the next few years. So SIS, we manage the largest number of hospitals in India as facility managers. As an extension from the care that is provided in the hospitals, we want to get into the homes and provide that same service. It is also a B2C play for us. An extension of our business called VProtect, Alarm Monitoring and Response, which is India's largest B2C security services provider. There's a very strong synergy of the VProtect and Imoha business, and we see a rapid expansion opportunity and synergies for both sides. Similarly, for example, in just Gurgaon itself, we manage 125 condominiums. All of them have a very large growing segment of elderly population. Imoha is already present in many of these condominiums as a separate kiosk, providing the services required for the elderly care people. And there again, there's a lot of synergy that we see. Apart from that, there are many other services, right from our pest management.
Right, you know, that's exactly what brings me to my question, Mr. Singh. Then why just 4% stake here? You could have gone ahead with a much higher stake. You obviously have the bandwidth, and it's 250 crores you valued that company at. What's the opportunity here for you to upsize this?
So we retain that option, and we will be actively involved in the business. And at the time when we see it achieve the scale and the fitment with our overall mainstream business, we will definitely consider that option.
Is there a timeline though, Mr. Singh, that you plan on taking the stake higher to say 8, 10, 12% after a specific duration or time, or is it conditional to the milestones that this company achieves after this first bit is completed?
It is conditional to the milestones. As is obvious at this stage, the EBITDA numbers would not make sense for SIS to be upping the stake. But we expect over the next couple of years' time, there will be enough merit for us to look at it for hiking a stake.
And what valuations would it be done at? Because, I mean, that brings another overhang of some money going out of the company as you increase your stake, right? Milestones would be achieved. The valuation currently is 250 crores to the company. At what value are you looking to up it?
We will have a preferential entry valuation at that time. But of course, it will depend on the growth that the business overall achieves over the next couple of years' time.
All right. So we'll, talk about that bridge when we come to it. Let's talk about the other part of the business itself. What about your growth in this year and the outlook for the next year? Because of the first 9 months, which are reported publicly, the growth has been just about 9.3%, which is much lower than your historic growth run rate. So what have you done in the fourth quarter so far, and the outlook for FY25, if you must?
So we maintain that we will be achieving on an average a growth of 15% on the revenue and EBITDA side. And our EBITDA definitely has grown to that level, as well as on the EBITDA margin percentage. So our EBITDA margin percentage in the security business has gone upwards of 6%, which was at the pre-COVID level. And the other segments are following the trend. So overall, the entire EBITDA percentage has grown for the group, which had been our main focus. The second focus was on our cash collection, which Q4 we've seen very encouraging trends. And when we announce the results, hopefully we'll be able to share that. For the next year, FY25, we see a very strong growth opportunity in all our segments. And that will lay the platform for our Vision 25 to 30 that we are working upon right now.
So does all your segments include the security solutions business as well? Because the international business of that aspect of your company, the revenue growth has been sluggish. The margins have not seen a lot of improvement. There was also downsizing of one of the contracts from one of the customers and the loss of a contract in Australia as well. What are the trends that you are seeing for this particular business going into the next year, Mr. Singh?
So international business has remained a steady business. It is not a business that will deliver very high revenue growth, but it is in the high single digits. The EBITDA is also not as high as the Indian market. But if you look at the other side of the balance sheet or the DSO, the working capital, it's much more attractive than the Indian market. So it's a good balance. We see the growth in both the revenues and EBITDA, and our focus remaining on the Indian market is already at about 70% EBITDA contribution from the India business, and that will continue to grow. Apart from that, we are beginning to look more aggressively on the inorganic side, the M&A play, and we hope to announce a few things in the Indian market very soon.
All right, we'll await those announcements. Just two questions. One, you said that FY25 growth will be a lot better. It will set the platform for the vision 2025 to 2030. So I just wanted to know, what would be the broad contours of that vision? Where do you see the company in terms of revenue margins, revenue mix by 2030? You're working on that. And in light of that, what are the expectations for FY25? If you could quantify that for us.
I don't think I'll be able to forecast the exact numbers, but as an overall guidance, we will focus on the three metrics. The revenue EBITDA growth of about 15%. We want to focus on the ROCE and ROE metric, which we hope to continue at the 15 to 20%, and the OCF to EBITDA ratio at 50 to 60%. These are the three metrics that we want to pursue, and we are confident of delivering over the next few years.
What about debt? Mr. Singh, your net debt around 1,058 crores. Do you plan on bringing that number down as well going into FY25?
As of now, too, if you look at the debt EBITDA ratio, it is not that high. It is below 2, which is at par with the industry standards or even below that. But our effort has been to focus more on the collections. And as I mentioned, in Q4, we've seen definite progress in that, which will help our debt reduction also.
Right. I am looking at your FY23 numbers. You're likely to grow 15% on that in FY24. And your target for the next 5 years would be about 10 to 15% sort of revenue CAGR. Back of the envelope calculations would suggest that by FY30, you could be anywhere between 25,000 to 27,000 crores on the top line. Would that be a correct assessment?
Yes, and that depends on how much we add through the inorganic also. So depends on how much M&A we do. It can be even higher.
So this 15% is purely organic, and thereafter whatever inorganic opportunities you get.
Correct.
And at that level, what would the margins be broadly?
We want to stabilize or increase more than the pre-COVID level, which was about the 6%. So, yeah.
All right. Thank you so much for joining in. Wish you good luck for the long-term plans for the company, and also will be interested in knowing the growth of the elder care vertical that you have embarked upon and the synergies that you're talking about. Wish you good luck for the fourth quarter numbers as well. Okay, with that, take a short break. Come back, tell you more on the other side of this short break, where we talk about stocks, individual, news pieces, a bunch of them buzzing around. There's Kolte Patil, there's Vedanta, Bharti Airtel up around 1.5% as well. You probably get in some comments coming in from the Supreme Court as well, from Ashmit.
Back with us here on Chartbusters on CNBC TV18. One stock that has moved and is possibly the stock of the day today is Vedanta. And that stock is up 7% now. The stock is trading at a 2-year high after CLSA upgraded the stock to a buy recommendation from an underperform rating. And in an interesting note there from CLSA, because they're saying that Vedanta is well placed to benefit from this ongoing commodity upcycle. Now remember, Vedanta has businesses across aluminum, zinc, copper. All the copper prices, zinc prices across globally are also seeing a sharp surge as well. And also what CLSA also says is that the company's ongoing efforts to raise capacity and profitability across segments will augur well for the company going forward. Remember, they are currently undergoing a process of demerging the business into 6 different entities, which they plan to complete by this financial year, that is FY25. And their leverage trajectory and the corporate structure will be the key to watch out for going forward, is what CLSA is saying. Now remember, Vedanta has also given a guidance that they plan to reduce debt by around $3 billion over the next 3 years, without adding on to incremental debt onto the listed entity as well. So that is a positive that CLSA thinks so. And as a result, it has raised its price target as well to 390 rupees from 260 rupees earlier. So that's a 50% jump up there, and as a result of which Vedanta is seeing a sharp surge in today's trading session. 7% higher at a 2-year high now is Vedanta, 361 as we speak. But the other stock that is doing very well in today's session is Bharti Airtel, and that is because Antique has initiated coverage on the stock with bullish commentary. Rima is here to tell us more. Rima, tell us why Antique is dialing Bharti Airtel right now.
Well, they're saying that this could be Bharti's best ever financial performance strength in over a decade. That's the reason why, Antique has initiated coverage on Bharti Airtel with a buy call, and they've put the target price at 1,505. The key reason why things are improving for Bharti Airtel, and the best that we've seen in a decade, is because of tariff hikes, the upgradation of 2G subscribers to 4G, strong growth in their enterprise business and fiber to the home, and also a decline in the capex. Capex for the company was high over the last 2 years because of the first 4G rollout, then 5G. But now the 5G rollout is completed, and therefore the incremental capex spend will come down, which leaves more money in the hands of Bharti Airtel, which according to Antique will go in deleveraging their balance sheet. So according to them, return ratios can top 20%, and also the historic high cash flow will drive balance sheet deleveraging. Back to you.
All right, that's about Bharti Airtel. That stock does well right now, up around 1.5%. What we'll do is we'll take a short break, and as we do that, let's tell you an important announcement. All right, before that, Hormas, we have something on the programming note as well?
No, but the other one that we were planning to do, we're planning on talking about, is the fact that some commentary coming in from the Supreme Court as well for the Reliance Infra case. But Ashmit will join us in a bit on the other side. But as we wrap up this edition of Chartbusters, we have an announcement to share with you all. We are launching CNBC TV18's first ever live personal finance webinar, which is CNBC TV18 Accelerate, the personal finance handbook, with Sonia Shenoy, where she'll be joined by 3 well-known experts on Saturday, the 11th of May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, be it insurance, tax savings, managing your portfolio, retirement planning. There's a lots to learn and lots to do as well. Whether in your 20s, 30s, or even in the 40s, this live webinar is for you. We have limited seats, so don't miss this chance. Register now. Scan the QR code to register or log on to cnbctv18.com, and we'll see you on the 11th of May.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and the story is shifted from large to the mid-caps. So it's been steady for the frontline indices, 22,700 on the Nifty, a gain of about 0.3%, but the mid-cap index, that's where the action is. The mid-cap index is up 0.8% and it's moved to the day's high.
Complete bull charge, that's what it is, right?
Absolutely.
And even on large caps, let's not forget that we do have a headline for you. The index has scaled 22,700 on the Nifty, so it's not bad going for even the large cap universe. And today you have participation coming in from banks. Banks have they've been leading this leg of the up move, and that continues even today. So if you look at the bank Nifty, it's actually doing better than the Nifty. But Reliance has started performing now. Last couple of days, that was my constant growl saying Reliance is underperforming, Reliance is underperforming. That's kind of changed, and right now it's on the top side of the screen. And the other big trend for the day is commodities. Whatever is happening in the commodity markets, that's having a direct bearing on the way stocks are reacting. So, for instance, some of the names like BPCL doing better because there is a bit of a cool off in oil prices. But look at Coal India, look at Hindalco, ONGC. It's really a JSW Steel. It's an out-and-out commodity play, and we will talk a lot more about that as we go forward. But yes, absolutely. I mean, the mid-cap market is definitely stealing the thunder. The index is up about 0.8%. Though if you look at the advanced decline ratio, that's the thing. Today, it's more of the index mid-caps that are doing well. But overall, if you look at the advanced decline ratios, it's pretty much neck to neck in terms of the gainers and the losers. 1,100 stocks advancing and a little over 1,000 stocks on the declining side. But very much a green screen. So let's straight away get to our first market conversation on Trading Hour. Chirag Mehta from Quantum AMC is our guest on the show, and let's get some perspective going with him. Chirag, great to have you on. Thank you so much for joining in. I think investors who are already invested in the market, they are simply smiling, looking at this rally continue, this massive bull charge continue. But the ones who are looking to deploy additional money, they're the ones feeling a little left out, confounded, confused. So at the outset, what are your opening thoughts on what is turning out to be, the breathtaking rally pretty much continuing?
Thank you, Surbhi, for having me on the show. So I think what we are seeing is a continuation of recovery in the economy. The economy looks robust. All the leading indicators look pretty constructive in nature. So I think the rally is here to stay. So we are positive on the economy, and that is what is driving the markets to some extent. There is hope that there could be China stimulus. The growth expectations on the global world are also changing. What was earlier a pessimistic scenario that global world is going to slow down, it's not happening anymore. So in all sense, I think there is support from the global world from a growth standpoint, as well as India is doing very well from a growth perspective. So that tells us that the rally is here to stay, and I think we are pretty constructive. And the levers that have been taking this rally are here is going to be the same levers that we'll see going forward as well. Led by capex, government capex. Now we are also seeing green shoots in private capex coming through. Consumption is still slow. We have seen uptick in two-wheeler sales in rural areas, and that is more driven not by new purchases, but our sense is that it is more driven by a replacement demand. If you see the last big cycle that we had in two-wheelers was because of was about 8-10 years back. And now we are seeing more of the replacement demand kick in, telling us that there is recovery in that space as well. So overall, we are very constructive. The capex plays here, which will be the biggest driver, followed by household capex. We are seeing housing activity being very buoyant, which we think will continue and therefore has a cascading effect on the overall economy, right from building materials to other ancillaries and consumer discretionary that come along with it, along with consumer durables. So I think there is a lot more traction going on in the economy, and it's going to be a similar growth trends that we have been seeing, a continuation of that for some more time.
Do you want to share some of your portfolio ideas or recommendations for this capex theme? Because it's been running for the last 2 to 3 years and most of the stocks have done very well. So it's great if it's already in your portfolio, but for fresh investment to play this capex theme going ahead, which stocks would you recommend?
So I think if you see from a capex standpoint, a lot of it is in the price because, there is demand, there is traction in that sectors, industrials, be it power. So all those, there is a good amount of traction in those sectors. but much of it in the price. So you need to look at niche areas. For example, when it comes to power, there is a great theme going on in, say, smart meters, for example. So you need to look at those kind of niche plays which have not yet fully priced in the order flows and therefore the revenue growth and earnings growth. So probably you could look at those sectors, and within those sectors you'll have to look at niche plays rather than looking at just frontline plays within those sectors.
Any other niche plays that you would ask investors to look at, analyze? So smart metering is one. Anything else that you would you'd like to highlight?
So if you look at even within those sectors, like recycling is a big story that is playing out. You have water-related, waste-related plays which are looking constructive from a long-term perspective. So you have many things, but you need to look beyond the frontline growth trends. And if you were to look at within the frontline growth trends, it's going to be the usual banking and financial sector or the IT sector is what we like. And in the consumer discretionary, you need to look at themes like, for example, two-wheelers, four-wheelers, where we have a constructive story playing out. And we think that will continue for some more time.
Okay, so that is the CAPEX theme. Tell us about some of your other biggest portfolio overweights. I mean, whether it's BFSI, consumer. Just tell us what your next big bet is beyond CAPEX and how are you looking to play it?
So from a valuation standpoint, we still like banking and financial space pretty much. Valuations are still constructive. There is not much worry from a NPA perspective. There is still growth. Only lingering concern was the deposit growth that we were not seeing in the banking sector. But our sense is that given the franchisee that these many banks have, I think there is some cyclicality to that deposit growth. But beyond that, we think that deposit growth will catch up as we go forward. So there could be some deviation away from, for example, banking and CASA and fixed deposits that we are seeing. But I think into capital markets, etc. But probably over time, I think you will see as incomes increase, there will be space for even some sort of fixed deposit growth or CASA growth, as well as the growth in capital markets. So we like both the themes. From a banking standpoint, banks look very conducive from a valuation standpoint. Whereas in the capital market space, we have seen a good run up already in many of those names. So probably at some correction, we could be looking at buying those further in our portfolios.
About IT, frontline IT is one of the preferred sectors along with banking and I think two-wheelers. Now, in IT, over the last 12 or 18 months, it's been some of these mid-cap IT stocks where the growth rates have been strong, like a Persistent, Coforge, or some of the ER&D plays, like a KPIT Technology, Cyient. These are stocks which have outperformed. Going ahead, should investors continue to bet on the outperformers of the last 1 to 2 years, or is it time to look at the at-scale big services companies to make money?
Sure, I think we like this space across. So in large cap portfolios, we have exposure to the frontline names. In these small cap portfolios, we have these small budding names in the IT sector. So we like the space across the spectrum. What we are seeing is there was some sort of pessimism related to growth trends in this sector. But I think that pessimism was overdone. And we were big buyers when these stocks corrected in the interim, and we continue to like these stocks. We are constructive that outsourcing is here to stay and will only increase going forward. AI trends was one of the other headwind that we were hearing from market experts. But AI, I think Indian tech companies have shown time and again that they kind of catch up with the emerging trends and benefit out of it rather than lose share. So from those perspectives, I think we like this story. I think AI, the biggest beneficiary, will again be Indian IT companies. We are seeing already IT companies shape up their training programs towards AI. So I think we like this space across the board.
Chirag, finally 30 seconds left on the chat. I just want to end with your take on what's happening in the commodities universe and whether you think there's a fundamental reason to play these stocks? I mean, look at the way metals have shot up. Even refiners have done really well for other reasons beyond just the price moves. I mean, the expectation of pretty high margins. Just leave us with your take on oil and gas, on metals, the commodities play.
So our call is that metals and oil probably should trend lower from a price perspective. We think that, currently the news stories around China stimulus growth holding up well in the developed world, etc., has led to this uptick in metals. Probably, I think it's kind of moved beyond what we would have expected. So I think both oil and metal prices should head lower over a period of time as this story kind of fades out. So we think that best of the prices probably are behind us. Probably metal prices have peaked, and therefore we don't see much traction in this sector in a big way, barring some places where we have valuation comfort because of the earnings growth that will kick in many of these, which still look buoyant for a couple of years. So over and above, we are kind of not buying anything in this sector at this point in time.
Right.
And that's what our take is.
Chirag, thank you very much for joining in. Look forward to more such conversations. From equities to commodities, where everything from gold, silver, cocoa, everything's hitting new record highs. Manisha joining in. Manisha.
Well, thank you so much for that. Everything in commodities actually seems to be doing quite well. Energy is the only place where we have seen some profit taking come in today, but that also seems to be inching up on your screens right now. But apart from that, whether it's about precious metals and industrial metals and soft commodities as well, many of these prices continue to run up on the higher side. Take a look at gold prices, and we are trading at around $2,360 an ounce in the international markets there. That's an all-time high. Silver at 28.19 on your screen is a 3-year high. But for the Indian markets, gold and silver both are trading at an all-time highs. It has been one-way rally in the last 16 or 17 days that we've seen into this space. Well, valuations are higher, as Chirag was pointing out, and perhaps it's overheated as well, but the momentum still on the higher side. Come on to industrial commodities, industrial metals, that is, and here as well, everything seems to be trading at a multi-month highs. Zinc, I'll start with that, is trading at a 1-year highs. LME copper, while is trading at a 14-month highs, the Chinese copper prices are trading at an all-time highs. Markets are anticipating, one, they are reacting to, of course, the stronger data that we've seen. Manufacturing activity across globe seems to be picking up, and there are expectations of China coming out with further stimulus measures in sense of property sector that has been supportive. Moving on, when you look at platinum prices, that's trading at a 4-month highs. Tin is trading at a 15-month highs, aluminum prices at a 13-month highs, and this can go on because many of these metal prices are doing quite well. Even iron ore prices from its 10-month lows have moved into 2-week highs as we trade right now. Soft commodities also have been doing quite well. Cocoa prices, for one, have been trading at around all-time highs at $10,000 a ton. I mean, cocoa prices have gained up by 150% in this year alone. Rubber prices trading at a 3-week highs. Coffee prices at an 18-month highs. And I can go on with the list, but most of the fundamentals do look strong. There are supply disruption concerns, and with demand picking up, these are the prices doing quite well on your screens.
Oh, indeed, everything seems to be doing well. Hard commodities, soft commodities, liquid commodities, solid commodities, Manisha. Thank you so much for that, Traps. It's really a huge bull market going on out there. Thanks for joining in. Well, with that, we do have to take a very quick break. Come back on the other side, and it is all eyes on the IT sector as the Q4 earnings season is about to get underway. So we'll be putting the spotlight on the expectations, also what to expect in terms of just commentary. Looking forward to FY25. Kumar Rakesh of BNP Paribas is going to join in for this.
Welcome back. Now, the tech sector is in focus ahead of TCS's fourth quarter numbers on Friday. Now, BNP Paribas, in a recent note, said that the IT industry has possibly bottomed out, and they expect fourth quarter constant currency revenue growth to range between +1% to -1%. To talk about the trends, the outlook, we're now joined by Rakesh Kumar, VP of Equity Research at BNP Paribas, to take some questions. Rakesh, great to have this conversation. This is Rima here. Can you talk about the statement that you've made in your report that IT earnings have bottomed out? And also, the pace of recovery, will it stay at these, middling kind of growth rates for the next few quarters, or will we see a sharper recovery? What are growth numbers looking like for FY15 and FY26? FY25 and 26. Yeah, go ahead.
Got it, Rima. Good morning. Thank you for having me on the show. So the pace of recovery, what we are looking at, even if you are looking at some of the guidance, full year guidance that the companies have given, even at the lower end of it, it implies from where the December quarter YOY growth was, year-over-year growth, we would be looking at recovery across most of the companies into the March quarter. So while there are still concerns on the discretionary demand picking up, at least cyclically, we would start seeing many of these companies to start reporting better year-over-year growth in the March quarter itself. Last quarter commentary also was indicating to some extent that there are some signs of green shoot. As we move into FY25, the base case expectation, at least on the industry growth, would be that it should do at least 2 percentage points higher than where we would be ending in FY24. Within that, some of the IT services companies with much stronger deal wins and better execution will possibly grow stronger than that. But more importantly, within FY25, as we move towards the end of FY25, towards the second half, we expect that the discretionary demand should start picking in, and that could potentially accelerate the overall growth of the industry. As you would have seen over the last 2 years, this discretionary demand was one of the key catalysts to drive the industry growth lower, and specifically in the existing contracts. Not necessarily in the new deal signings, because they have been quite robust actually for the industry overall. It's the existing contracts which were getting reassessed and possibly ramped down, and that was what was impacting the growth. First stage would be that we would start seeing the stabilization on that front, which we believe that has already started playing out. There are no material incremental ramp down in the projects. And as we move into the second half of fiscal 25, we should start seeing some of those projects ramping up, some of the new discretionary projects also coming in, and that can potentially accelerate the growth and should set us well for FY26 to be even stronger growth here.
Rakesh, hi. Thank you very much for joining us on the show. So I want to ask you that, as the IT sector has gone through this post-COVID challenging phase, and now, as you're saying, that we're probably past the worst and the recovery moves forward from here on. In terms of the top tier companies, which are the ones that you think are coming out right on top in terms of weathering the challenging phase the best and taking charge of the AI opportunity? I mean, for instance, Rima's poll for Q4 tells us that TCS is going to lead the charge on top line growth, and TCS has been, one of the better performers. So just tell us, top tier IT, which have become your favorite stocks in terms of how companies have responded to the challenge and how they're willing to now capitalize on the AI opportunity?
Hi, Surabhi. Actually, if you look at these IT services companies over not just last year or so, over the last couple of decades, what they have been really good at essentially is not taking any technology call. Whichever technology comes along, they prepare themselves well to execute and implement projects associated with that. Be it mainframe, be it the era of cloud, and now